Policy dividend options.
Dividends are considered a return of overcharged premium. When a participating insurer experiences a surplus, it returns excess premium payments to policy owners in the form of dividends. Dividend options are ways policy owners can use dividends paid by the insurer. There are 4 standard dividend options and a so-called 5th dividend option that policy owners can choose from. The first option is cash, by which the dividend is paid to the policy owner. The second is premium reduction, wherein the policy owner has the insurer keep the dividend and apply it toward a future premium payment. Third is the accumulate at interest option, wherein the dividend is held with the insurer to accrue interest. Fourth is paid-up additions, in which the dividend is used to buy additional amounts of paid-up insurance. Lastly is the 1-year term option, in which the dividend is used to buy 1-year term coverage with a face amount that can be purchased with the dividend.
A dividend is an amount returned to the policy owner out of an insurance company's surplus funds. In a practical sense, it is a return of premiums that exceed the insurer's expenses and mortality experience. Only certain types of insurance policies produce dividends. The policy owner decides in advance how he or she wants the dividend to be applied on the options available through the policy. Policy dividends are payable only with participating life insurance policies. They are most commonly issued by mutual insurance companies. A participating policy is one that participates in the insurer's divisible surplus, which is determined after accounting for liabilities, including death benefit payments, reserves, capital, and expenses. Participating policy dividends are effectively a return of unearned premium. As long as they do not exceed the total premiums paid by the policy owner, they are treated as a tax-free return of premium. Since life insurance premiums are not tax-deductible, it is only fair that a return of premium would be tax-free. Dividends are not guaranteed. While insurers try to pay policy dividends consistently, they and their producers may not under any circumstances state or imply with certainty that policy dividends will be paid. This prohibition against guaranteeing policy dividends applies to producers too. Dividend options. Participating life insurance policies include provisions that enable the policy owner to choose how he or she wants to apply any declared policy dividends. These most common options, known as dividend options, are receiving the dividend in cash, applying the dividend to reduce the premium, leaving the dividends with the insurer to accumulate at interest, using the dividends to buy additional paid-up life insurance, and using the dividends to buy 1-year term insurance. Policy owners may change their selected dividend option at any time. However, if the new dividend option increases the pure insurance risk to the insurer, e.g. to the 1-year term option, the insurer can require the insured to submit evidence of insurability. Regarding receiving the dividend in cash, under the cash dividend option, the policy owner simply elects to receive the dividend in cash. The insurance company sends a check for the amount of the declared dividend on the anniversary date of the policy. Policy dividends received in cash are generally not income taxable. Reduce the premium. Under the premium reduction option, the company uses the dividend to reduce the next premium due. For example, let's suppose that the annual premium was $1,000 and that the declared dividend was $250. In such a case, the policy owner choosing the premium reduction option would receive a premium notice for $750. Accumulate at interest. Under the accumulation option, the insurer holds the dividends in an interest-bearing account for the policy owner. The policy owner can withdraw the accumulated dividends and interest at any time. While dividends are generally not taxable, the interest earned on dividends held at interest is taxable income in the year credited. This holds true regardless of whether the policy owner withdraws the interest earnings or allows the interest to accumulate. Suspend premiums. An option that is available to policy owners who have let their policy dividends accumulate at interest is to use the accumulated funds to suspend premium payments. The length of time for which premiums can be suspended is dependent on the value of accumulated dividends. The larger the account, the longer the premiums can be suspended. Buy paid up additions. Under the paid up additions options, the dividend buys an additional paid-up insurance of the same type as the base policy. For instance, a $300 policy dividend on a whole life policy would be applied to buy an additional amount of paid-up whole life insurance. The premium rate for the paid-up additions is based on the attained age of the insured when he or she buys the addition. As each year's dividends are applied to buy these paid-up additions, the age at which they are bought increases each year. And because the age increases, the premium rates for the additional insurance increase each year too. Paid up additions are life insurance policies in their own right. As such, they are eligible for dividends and they each have a cash value that grows up over time. Upon the insured's death, the total death benefit equals the face amount of the policy plus the face amount of the paid up addition. Over time, the cumulative effect of these expanding policy values can greatly enhance the policy's total value, all for the same premium in effect when the policy was issued. Regarding buying 1-year term insurance, in addition to these 4 basic dividends options, various combination dividend options are available. Most of the combination dividend options involve 1-year term life insurance. They are often referred to collectively as the 5th dividend option. Under the 5th dividend option, policy dividends are used to purchase 1-year term life insurance. Depending on the specific option selected, the term life face amount may equal the base policy's cash value, or it may equal the amount bought with the dividend. If the first option, equal to cash value, is elected, it is likely there will be some leftover dividend amount. In that case, the unused dividend can be applied to any of the other 4 basic dividend options. Whichever term life option is selected, the additional coverage is provided through a 1-year term life policy that expires 1 year after issue. Because the term life face amount consists entirely of pure insurance protection, it represents a greater risk to the insurer than any other dividend option. If the policy owner requests a change to this option after the policy is issued, the insured will have to provide evidence of insurability. Paid up insurance. A less common dividend option, the paid up insurance option, lets the owner use the dividends to pay up the life insurance policy early. A policy owner who chooses this option could pay up a whole life policy several years early, depending on the policy. After the policy is paid up, the policy owner does not owe any more premiums and the policy benefits continue in force. Key points. Policy dividends are payable only with participating life insurance policies. Participating policy dividends are effectively a return of unearned premium. While insurers try to pay policy dividends consistently, they and their producers may not under any circumstance state or imply with certainty that policy dividends will be paid. While dividends are generally not taxable, the interest earned on dividends held at interest is taxable income in the year credited. Paid up additions are life insurance policies in their own right. As such, they are eligible for dividends and they each have a cash value that grows over time.
Life insurance policy dividends are sort of like get it, and sort of like income tax refunds. It's your money that's coming back to you, yet it still feels pretty good when you get it. And that's, if you understand policy dividends, you understand that's really what a policy dividend is. It's a return of, if you will, excess premium called divisible surplus back to the policy owner. Now, this lesson talks about the different ways, the different options available to the policy owner to receive those dividends. And I want to take a moment to talk about one of those options in particular, and that is the paid up additions dividend option. Personally, I believe that if a policy owner, if an owner of a participating whole life policy really understood the paid up additions option, they wouldn't even consider any of the options, and here's why. With a paid up additions option, the dividend is used to purchase an admittedly small piece of paid up life insurance protection. That paid up policy addition accrues its own cash value. So, for the base premium that the policy owner is paying to own that participating policy, they will actually realize an increasing death benefit as each paid up addition every year is added to the policy, and the cash value will grow significantly bigger because each paid up addition generates its own cash value. Let me give you a quick example. This is an annual policy summary of a participating whole life policy, and let me give you the basic facts of this policy. This policy was issued with a $50,000 face amount a number of years ago. The monthly premium for this policy is $61.95. Okay, it is what it is, as I say. But let me tell you, over the intervening years, what this policy has grown to. In addition to the basic policy face amount of $50,000, there is now paid up additional insurance of $23,000, almost $24,000. So for that same $61.95 monthly premium, this policy now has a combined total face amount of almost $75,000. Better yet, the cash value, which is $15,000 for the base policy, also has almost $10,000 of cash value for the paid up additions. So tying it all together, for that $62 monthly premium, this policy now has a $75,000 total death benefit and almost $25,000 in cash value. If your customer fully understood the power of the paid up additions option, I don't think that they'd be interested in any of the other options available.